So let's get started again. This is always a great pleasure for me. Many of you know Rado Franchione, and he's been at, I keep asking him back, and he keeps making the flight from Europe, from Zurich to here, and then when are you going back again, Rado? Tonight. So I can only thank you, my dear friend, my colleague, and I've learned so much from Rado. So it's a pleasure. Let's give him a round of applause, guys.
Bob, you are always humble because Bob is my former teacher, so you can imagine who learned from whom, but that's another story. So, dear Bob, ladies and gentlemen, thank you for giving me the opportunity to talk to you today. I'd like to share some thoughts on three topics with you. My first thesis is, in a globalized economy, exchanges must go global as well. Their role is to organize safe and orderly markets for efficient price discovery. And this is a global public good. Secondly, price discovery is increasingly supplemented by further services aimed at risk management. This is reflected by the growing trend of exchanges to become integrated infrastructure providers, as well as by current legislative initiatives in the US and in the EU. Thirdly, I believe that the dual role of exchanges as global providers of price discovery and risk management services is verified by the recent strong increases in exchange turnover as a consequence of market turbulence. Exchanges are anchors of stability in times of increasing volatility. What are the classical functions of an exchange? Exchanges provide the infrastructure for making markets work. First of all, they contribute to economic growth by providing companies from the real economy with access to capital markets. On these capital markets, they bring buyers and sellers together, concentrate their orders, and execute deals on liquid and transparent markets. By creating conditions for liquidity and transparency, they discover market prices. And by discovering prices, they provide an important service to the economy as a whole. Market prices are the best guarantee that capital is put where it's needed most. By implication, exchanges are also useful for regulators concerned with protecting investors, improving the functioning of markets, and reducing systemic risk. In the past, regulators performed these functions for their home country only. At present, and much more so in the future, regulators need to coordinate internationally. In Europe, we see a clear trend in this direction. New EU supervisory authorities have been set up to improve supervisory structures. For instance, the European Securities and Markets Authority, ESMA, which directly supervises service providers in the securities industry and develops guidelines for their regulation. Exchange organizations with global reach will be well positioned to work with international regulators to facilitate transparency and standardization of the global markets, while at the same time preserving national regulatory models. They can serve as natural partners for harmonization and transparency across jurisdictions. Our work at the Deutsche Börse has changed because the work of exchanges itself has undergone drastic changes over the past 20 years. Changes have been driven by advances in technology that have cut costs and increased the speed of trading. Changes have been brought about by regulation, like the EU Markets in Financial Instrument Directive. And changes have been caused by competition, especially from new niche players on the markets, but also internationally between established exchanges. In response, this has triggered a wave of consolidation among established exchange organizations. As a consequence, fewer exchange organizations now span more markets and products. It has become a strategic necessity that in a global economy, exchanges must go global as well. It's not enough to focus on home markets. We have to expand and seek new partners to secure our position. This is also increasingly demanded by our clients. A representative of a leading New York-based bank was recently quoted in the financial press with the words, I quote, "Clients of exchanges are pushing for globalization as investors' portfolios take a global industry view, rather than a geographical one. Furthermore, the technology that is being deployed for equities and derivatives trading demand continual investment to attract low latency trading flow. So the ability to make these offerings scalable through consolidation makes sense from a cost perspective." End of quote. My personal scenario for the near future of the exchange world is there will soon be a very limited number of really global exchanges covering a broad range of financial instrument and infrastructure services. They will be in fierce competition with each other and at the same time open up new opportunities for new niche players at the other end of the spectrum, specializing in certain customer groups or types of securities. Slide 2. The merger project between New York Stock Exchange, Euronext, and Deutsche Börse has sometimes been portrayed as a story of Americans against Germans and vice versa. From a customer perspective, however, things look entirely different. The two most important business sections of Deutsche Börse Group already derive the majority of their sales revenues from outside of Germany. Eurex, our derivative subsidiary, generates more than 2/3 of its revenues from non-German Europe and a further 1/5 from the US. Clearstream, not Clearstream in Europe. Clearstream, our Luxembourg-based settlement and custody service provider, derives 2/3 of its revenues from outside Germany worldwide. And even Xetra, our electronic stock market, has more than 40% of its revenues coming from outside Germany. Also, it is confined to Europe for legal reasons. Slide 3. The same is true from an ownership point of view. Less than 1/5 of our owners are German, more than 1/3 are American, and the rest comes from all over the world. In other words, Deutsche Börse is already well on its way to become a global exchange. The proposed merger with the New York Stock Exchange Euronext will make the two of us together the most international exchange organization there is. This will provide us with an excellent basis to become truly global in the near future. What is equally clear, however, that in this globalized exchange world, financial centers such as New York or Frankfurt continue to matter. Exchange trading is not only about electronic networks, but also about networks of people. It is about creating communities brought together by exchange organizations. Exchange organizations continue to form the nucleus of flourishing financial centers and truly global cities. If we succeed in bringing together the capital market communities in New York and Frankfurt by creating the world's largest exchange organization, which I trust we will, then I'm sure this will be to the mutual benefit of both cities. By bundling our technologies and by making our markets accessible to customers on both sides of the Atlantic and beyond, we will improve liquidity and broaden the range of services we can offer. In transparent markets and in transparent products were at the heart of the financial crisis. Conversely, the crisis has shown that with their transparent and highly regulated markets, exchanges can make a valuable contribution towards stabilizing the financial system. Exchanges have been able at all times to guarantee orderly trading and therefore to help ensure transparent price formation. In addition, the central counterparties, the so-called CCPs, affiliated to the stock exchanges, interpose themselves between counterparties to financial transactions to become the buyer to the seller and the seller to the buyer, calling for collateral geared to individual risk exposure. In this way, CCPs safeguard trading against counterparty risk. This has also been recognized by political leaders worldwide. In response to the financial crisis, leaders of the 20 largest economies of the world have, in the G20 summits following the financial crisis, developed proposals for global standards regarding financial market reform. One key recommendation made by the G20 was the proposal to migrate OTC derivatives, where appropriate, to central market infrastructures. Such infrastructures include organized and supervised form of trading and CCP clearing. In the US, the Dodd-Frank Act has been used as a legal vehicle to enact these reforms. The formulation of the implementing measures regarding OTC derivatives trading is still in progress. In Europe, legislators have used the scheduled revision of the Markets in Financial Instruments Directive, in short MiFID, for proposing additional transparency requirements for financial instruments traded mostly OTC. MiFID contains pre- and post-trade transparency rules for equities, with the objective to improve market transparency for the sake of fair competition and investor protection. After nearly 4 years of experience, however, we need to admit today, despite the transparency and reporting requirements under MiFID, we know less about market structures than before. The share of OTC trading is growing across Europe, and this trading is taking place outside the transparency rules for organized markets. This results in a lack of transparency, discriminating not only smaller market participants and private investors, but also the more sophisticated institutional investors, as demonstrated by the financial market crisis. In addition, pre- and post-trade transparency is essential for central clearing. Robust post-trade processes rely on availability of transparency, and as the market practice in clearing goes towards real-time risk management, as offered, for instance, by Eurex Clearing, real-time transparency is needed to perform real-time risk management. Therefore, from a trading and clearing perspective, we appreciate an extension of transparency obligations to non-equity markets. Let me quote Mario Draghi, President-elect of the European Central Bank, quote, "Core financial market infrastructures must be strengthened to reduce contagion risks and to ensure that critical infrastructure is not itself a source of systemic risk. A key source of the risk transmission is the network of major institutions' exposures to each other, not least in the over-the-counter derivatives and in funding and repo markets. Central clearing arrangements can simplify and greatly reduce the risks associated with this web of counterparty exposure." End of quote. In other words, exchanges are not the root of this crisis, quite the contrary. We have continued to organize regulated, safe, and orderly markets, even in the worst of turbulence, and our transparency, safety, and integrity is now widely seen as a remedy against the excessive risk-taking that led to the crisis. At Deutsche Börse Group, we have, in addition, developed new solutions helping to keep the markets going even when liquidity nearly dried up. Even the fiercest critics of so-called vertical silos today seem to have turned into fans of vertical integration. Let me quote the Financial Times exchange expert Jeremy Grant. In his report and comment on the London Stock Exchange's recent bid for the London Clearing House, he wrote, I quote, "If the LSE succeeded in its bid, the UK bourse position would be significantly strengthened, while London could benefit from the creation of a large integrated exchange group." Unquote. So, not only the exchange, but also the financial center and the financial community would profit from such integration. I entirely agree, and I would therefore propose to finally abandon the pejorative term vertical silo and replace it by integrated exchange, improving safety and integrity for exchange clients. Risk management is at the core of the exchange business, and thanks to an integrated approach, exchanges like Deutsche Börse are able to offer new, innovative and integrated products for better risk management, both for our customers and for regulators. This does not mean, however, that we should not discuss making access to clearing easier for potential future customers. Integration and accessibility are not mutually exclusive. Our central counterparty for off-exchange derivatives developed by Eurex Clearing, setting in place an effective insurance against counterparty risk, starting with credit default swaps. To give you an idea of the safety mechanisms used by Eurex Clearing, we employ 7 lines of defense to ensure ourselves and our participants against the case of a member's default. The first and second line of defense consists of the liquidation of open positions and collateral. Next in line is the contribution of each member, the guarantee fund. Defense number 4 and 5 are the reserves of Eurex Clearing itself, as well as the guarantee fund contribution of all members. The latter amounts to approximately 1 billion euro. And the final 2 concerns the liable equity of Eurex Clearing, as well as the guarantee of Deutsche Börse as a parent company. Eurex Clearing is Europe's largest clearinghouse with more than 40 billion euros of deposited collateral. However, Eurex Clearing is very small compared to the sheer size of the off-exchange sector that so far is completely unregulated and unsupervised. Just to remind you of the magnitude of this sector, according to the latest data of the Bank for International Settlements, its volume measured in notional amounts outstanding was a staggering 600 trillion US dollars. Again, do not get me wrong, this sector certainly has its functions. For example, it provides flexible hedging mechanisms to risk taken by globally operating industrial companies. However, as the financial crisis has shown, it can also encourage excess risk-taking due to a systematic lack of information about risk and due to insufficient insurance mechanisms. This is why policymakers need to act and make the reform of this sector a top priority, and indeed a higher priority than attempts aimed at additional deregulation, which seems quite out of tune with what is currently needed to re-establish safety and integrity. One of our key strengths when organizing such solutions is our neutrality. We do not have to manage conflicts of interest. We avoid conflicts of interest vis-à-vis our customers. Therefore, exchange organizations that provide not only trading platforms, but post-trade infrastructure and market data services as well are in a unique position to contribute to a sophisticated form of re-regulation of capital markets in Europe. Not over-regulation that stifles innovation, but smart regulation that increases the global competitiveness of European economy. Because this is what capital markets are ultimately there for, to give the real economy access to thoroughly needed equity capital and to provide investors with fair, transparent, and reliable investment opportunities. In phases of volatility, we regularly observe that market participants restructure their portfolios via exchanges and not OTC, because only exchanges provide safe, transparent, and reliable trading venues. Apart from robust electronic trading and post-trading systems for regulated and supervised markets, the insurance against counterparty risk via CCPs plays an important role here. This applies both to stock markets and to the derivatives markets. In August, order book turnover on Deutsche Börse's electronic stock exchange Xetra more than doubled to 182 billion euro compared to the same month last year. And the derivatives exchange Eurex recorded an average daily volume of 13.2 million contracts, an increase of 69%. Of those, by the way, 9.1 million were Eurex exchange contracts and 4.1 million contracts were traded at the New York-based International Securities Exchange, ISE, a Eurex subsidiary here in New York. You know, Gary Katz was on the panel, the CEO, the acting CEO. So in parallel, we see a strong increase in volatility that has continued until September. At Deutsche Börse, we measure implicit volatility through the VDAX, volatility DAX. VDAX, it measures the degree of variation as expected by the derivatives markets for the coming 30 days. Whereas the VDAX had remained around a level of 25 plus minus 5 for most of the time in 2011, in August and again in September, we experienced a very strong increase in the index value, reaching nearly 50 at some stages, almost the double. While we are still far away from the levels of around 75 reached in October 2008, this development is certainly worrying and reflects the high uncertainty induced by the recent worsening of the financial crisis. It may seem odd to some observers to see exchange trading flourish in times when the rest of the economy is in deep trouble. However, just imagine how the financial markets would react to changes in market participants' expectations and worsening macroeconomic outlooks if exchanges did not exist. Would they refrain from restructuring their portfolios? Certainly not. But without exchanges, these restructurings would be taking place in risky, opaque, and unreliable environments in which frequent breakdowns of communications would be the rule rather than the exception. The absence of reference prices or indices would vastly increase the insecurity of markets. As a consequence, volatility would not be dampened, it would increase. And the resulting loss of confidence in the economy would be all the more severe. To sum up, the globalization of exchanges is a natural response to increasing competition and to the globalization of the major customers of exchanges. It's accompanied by a broadening of their services and thus enables the development of new risk management techniques. In sum, the globalization of exchanges makes markets worldwide more transparent, more reliable, and generally safer. Ladies and gentlemen, I thank you for your attention. Thank you.